If I'm not mistaken, several items are now more expensive than they were earlier, some by a bit of margin, others by a significant margin. While we do not currently have uncontrolled inflation, we have some exceptionally high costs for consumer goods. In this video, we will try to look at how inflation is affecting secondhand market prices. Stay tuned with me till the end and let us learn more about inflation. Secondhand market prices are spiraling out of control because of inflation. You've probably seen it on the news if you haven't noticed it in your daily life. From cars to watches to burgers, prices for a wide range of goods and services have risen across the economy. Some refer to these and other price rises as signs of imminent inflation, claiming that the situation would soon resemble that of the United States in the 1970s when the country experienced stagflation, or high inflation combined with weak economic development, high unemployment. In the view of many economists and government officials, including Chairman of the Federal Reserve, Ben Bernanke, this is just a short-term phenomenon. After the post-pandemic imbalances and bottlenecks are addressed, they predict it will cool. In the lumber industry, it appears that this is already taking place. It's also worth remembering that prices fell last year due to deflation in several parts of the economy. So this year's increase is only logical. What's going on right now? At 5% year-over-year growth, according to the Bureau of Labor Statistics, May's Consumer Price Index monitors inflation by tracking the costs of products and services from all sectors of the economy and comparing them. Faster than in the early 1980s, we've only seen it a few times. Though it has been lowering in recent years, the Federal Reserve's long-term inflation target is 2%. There was a 0.6% increase alone in May 2021. Instead of wondering why inflation was so low following the Great Recession, analysts did the opposite this time around. What is beneath the headline figure is perhaps more fascinating than the headline figure itself. Significant price increases or decreases in a single region might occasionally throw the overall picture off. This is why people talk about core inflation, which refers to prices without food and energy, which might fluctuate according to weather and oil availability. One area that has recently sparked debate is used autos, which saw a 7.3% increase in May after a 10% spike in April. The cost of a used car has risen by nearly 30% in the last year. The problem can take on a slightly different appearance when they're not involved. Used cars, to be sure, aren't the whole picture. The cost of various items has risen steadily during the last year, due to many factors, including rising oil prices, a truck driver shortage, and a significant jump in demand as people resume driving and flying. Gas prices have risen considerably in the previous year. Gas prices also dropped substantially during the pandemic, contributing to the increase. Hey, take a breather there for a moment. We're almost there. If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. Since the Great Recession, the unemployment rate has fallen, but inflation has stayed much below the Federal Reserve's 2% target rate. Because of this, the Federal Reserve was obligated to investigate the link between a tight labor market and rising prices. For a long time, economists predicted that as the labor market tightened and corporations increased compensations to compete for scarce workers, prices would rise as the high cost of labor was passed on to consumers. In the most recent expansion, which has been the country's longest in history, such a connection was largely absent. The Federal Reserve eventually devised a new system that allowed the labor market to remain hotter for extended periods. The central bank is willing to accept inflation of greater than 2% for a limited time. It also says it won't boost interest rates until the labor situation improves significantly. However, there are numerous unsolved issues with this approach's actual application. Future Federal Reserve officials will have to make a clear and unequivocal contrast between short-term price increases and long-term inflationary tendencies in the months and years ahead. Wholesale and retail costs were already rising before the beginning of the pandemic, according to industry observers. American consumers choose SUVs and pickup trucks with higher sticker prices. Because of infotainment, technology in dashboards and entertainment systems in modern vehicles, prices have soared. According to Peter Nagel, an automobile industry specialist at IHS Markit, supply chain shortages or other supply chain difficulties may encourage dealers to select their most profitable models. Almost everyone agrees that rapid price increases, sometimes known as hyperinflation, are a sign of trouble. They undermine political institutions, turn middle-class workers into paupers overnight, and render businesses incapable of planning. Hyperinflation supported Adolf Hitler's rise to power in Weimar Germany, often used as an example. Even if they surpass the Fed's announced target, moderate price rises are a source of more significant contention. For people with fixed-rate debt, a slight increase in inflation can be helpful. If I sell coconuts for $1 today and owe $200 to my bank, but I'm suddenly able to charge $1.05 for the next year, my loan becomes easier to repay. I just need to sell 190 coconuts plus interest. Inflation, on the other hand, may be a challenge for lenders. The bank to whom I owe $200 is clearly unhappy that I received 190 coconuts worth of money instead of 200 coconuts value of money. While politicians and the general public rarely show sympathy for bankers, those with low interest savings will find that their money will not stretch as far. Inflation is especially onerous for those on fixed incomes, such as students and many seniors. What happens to incomes determines whether inflation is positive or destructive for salaried individuals. In a high inflation culture, if a worker's pay rises faster than inflation, they may still be better off. While wages are rising quickly, especially for those with lower earnings, specific indications suggest that growth is not keeping up with inflation as it grows. Nonetheless, many households get government benefits, which may assist some families in maintaining a stable financial situation. Subscribe and hit that notification bell to help us produce more wealth-building content. You can count on Dinero Association to keep you up to date on the latest financial and economic developments. Tell us what you think about this video by leaving a comment below. We are Dinero Association, your partner in building wealth.